tech stocks, clean energy stocks, and Chinese stocks are all taking a beating at the moment, causing significant drawdown on our portfolio. In this video, I'll run through why I'm not too concerned and why the long game is important in scenarios like this. I'll also give a full portfolio breakdown in detail, covering off the themes that I see going forward, which should hopefully help to give an understanding of why I'm not too concerned when you look at it with a long-term view. Hi guys, hope everyone's safe and well. As always, please remember that the contents of this video are my opinions and my opinions only, and should not be considered as financial advice. Firstly, apologies, it's been a little while since I've posted a YouTube update. There's been a lot going on, but I did post put a post up last week just on the monthly performance for April. So that was quite an in-depth sort of review. But in essence, it was sort of meandering towards a bit of a flat month, and then the last sort of week or so, we did see a bit of a pullback, finishing the month with 1.80% in the red. But I've put a post up on that. We finished the month with a plus 1.48% gain, so we still closed that in profit. And I'm going to dive into quite a bit of detail in this video on the portfolio and the portfolio breakdown. So obviously there's a lot of volatility at the moment. There's a lot of fear, primarily in the three that I mentioned at the top end of the video: Chinese stocks, technology stocks, and clean energy stocks. I mean, if we just look at the NASDAQ today, it's down 2.22% at the moment. Still got a couple of hours till close, so a 2% drop in one day. If we compare that to, I think my portfolios for the day is around about just under 2% down. So yeah, tech stocks are taking a beating, Chinese stocks taking a beating, clean energy stocks are taking a beating all over the last sort of, the last month to 2 months. If we just quickly look at the NASDAQ, so this is the weekly chart. So as you can see, it's been in this sort of strong uptrend, and then from last March, when COVID hit, we saw the bounce up and surge really over the last sort of 12-18 months. I did post a video actually, I think it was a couple of months ago or sort of 6 weeks ago, because I was interested to see what sort of reaction we'd get around the previous all-time high, which was just under, where are we? Just under 14,000. I did feel like we were going to get a drop back, and I did, and that was in the video that I posted at the time. So it's not me just sort of, saying I predicted the future on there, but it did feel like we were due a bit of a consolidation. So we got a breakout. So I thought, okay, maybe I'm wrong on this one. Maybe we are going to stretch to new all-time highs. But then since then, we have sort of sharply fallen steep down. So this could drop further. This could drop all the way back down to sort of the 12,500 mark. And then, like I say, potentially we could see it range for a little while, which wouldn't be the worst thing in the world after such a sort of a strong leg up over the last sort of 12 to 18 months. I mean, if you look going back a few years, if you go back to 2015, you can see here there's sort of a bit of a range for almost a year and a half. So there are periods again here, 2011 to sort of into 2012. There's a bit of a consolidating period. So we could potentially see it pull back. I mean, there's still quite a drop to go, to be fair. So it might be that we just sort of slowly drift lower rather than like a sharp drop off. But so the NASDAQ sell-off, has impacted us performance-wise. I mean, I just mentioned it just a second ago. For April, we were down 1.80% for the month. So far this month, we're down just over 3%. Probably going to be even more, probably closer to 5%, I would imagine, after the end of today. We've seen another large sell-off across the board, really, in growth stocks, Chinese stocks. I think there's a few reasons. I think there's more than a few reasons. There's a lot going on at the moment. I think when you compare to last year, everyone was sort of proclaiming to be amazing investors, amazing traders, because essentially the stocks were just going up. You know, you could pick the majority of any stocks and they were just going up. And obviously this year's a lot more difficult conditions. The sort of the macro environment is, there's a huge amount going on, which I'm looking to sort of try and cover off in this video. So I guess if we start with the portfolio breakdown, let's just see if I can make this a bit bigger so you can see it. So hopefully you can still see this. So this is the portfolio breakdown as it stands. Quite a lot of colours going on, but essentially I wanted to make it a bit more visual so that it wasn't just lines of text on an Excel spreadsheet. But essentially gives you an idea of the weighting of all of the stocks that I've got in my portfolio. So the top weighting at the moment is Momo with 3.44%, then Suncor Energy, then QDN. You get the idea. So the bigger the block, the higher percentage or the higher weighting it's got in my portfolio. So what I'm aiming to do here is give you a visualization, one on the weighting but two on also the themes of that weighting. And I'll try and explain that in a bit more detail and why these themes have sort of adversely affected the portfolio. So Chinese tech, as you can see on the right hand side here, takes up just under 16% of the weighting of the portfolio. So Momo, QDN, DouYu, Zep, these would all fall into that category. Baidu, Tencent Music Entertainment, these would all fall into that category. So as you can see, there is quite a significant amount of weighting towards Chinese tech stocks. I think if you're looking at it from a sort of geographical standpoint, I think the Chinese listed or even US listed Chinese companies take up about 30% or take the weighting of about 30% of the portfolio. So it's an area that I see a lot of potential in. They've been doing well sort of up until the beginning of this year. They've been doing very well. I think if you look at, if we look at very quickly the CQQQ, if we switch to that, just to illustrate my point. So yeah, up until sort of beginning February this year, so CQQ is an ETF of Chinese technology stocks. Just to give you a bit of background on that, this just gives us a better illustration of how sort of the overall Chinese technology stocks have been performing. So yeah, there was a big sort of like burn up until February this year, and then we've just seen a massive sell-off since. And obviously that's played a huge part in how my portfolio has performed, with a weighting of 15 or just under 16%. There's a few reasons why I think that's why we're seeing this sort of sell-off. Obviously there's a lot of talk or a lot of uncertainty around these new Chinese regulations that are being rolled out. The anti-monopoly regulations specifically. I mean, you can look at examples of recent ones for Alibaba and Tencent. In the lead up, or in all of the talk around the uncertainty, the talk around the regulations targeting these companies, Alibaba specifically, there was huge sell-offs in Alibaba stock. But then as soon as it was announced that there would be a fine and there was a nailed on amount for that fine, you saw a huge bounce back in that stock. And that all comes down to uncertainty. Essentially, the unknown causes fear and panic, and it causes people to dump stocks, jump out of stocks, because they don't know what repercussions they're going to be for the company. But as soon as the fine was announced, investors and the like can then calculate the impact of that fine on the company. So, and I think for Alibaba it was a bit of a drop in the ocean. But what the point I'm trying to make is, even though we don't know the extent of the regulations yet, it's the uncertainty that is causing the sell-offs in these sort of Chinese technology companies, especially the larger ones. I think that uncertainty around regulation, coupled with fears around inflation, which I will elaborate more shortly. So when you have the fears around inflation, that's also impacting on the growth stocks, and a lot of the Chinese technology and fintech companies are growth stocks. So they've got the double whammy of that as well, which is why I think you're seeing a lot of sell-off across the board with those. Also, there's still tensions around, US, Chinese trade, imports and exports. We don't know what the tax scenario is going to be around that. And obviously the relationship is still a bit tetchy. So I think there's been an awful lot of sort of negative, uncertain news around Chinese tech stocks, which has hit, the likes of Qdian, Douyu, especially Douyu. I think that's taken a bit of a 10% sort of haircut today. So 10%, Baidu, all of these Chinese technology companies have taken a huge hit because of the uncertainty, because of potentially inflation worries, because of tension, US-Chinese tension. So that is one thing that's obviously weighted to the negative side, the portfolio with such a large holding. Now, yes, it's impacted us, but when I sort of come back from a macro level and look at the companies individually, from a fundamental standpoint, I'm still more than happy with the companies that I've got. I mean, if I could keep adding positions, I would. Unfortunately, I've not got enough cash in the portfolio to do that. And I don't want to overexpose myself, any more than I need to, just in case there's any sort of unforeseen circumstances. But essentially, when I'm looking at these companies fundamentally, I'm liking what I'm seeing. Strong growth, strong financials, good sort of forward-looking potential. Yes, there is still uncertainty around regulation, but I think longer term, I think these will play out, and we will see a bounce back in these Chinese technology stocks and the rest of the Chinese stocks that we've got. So it's almost like we're taking a bit of a hit short term, but we're looking at the long term game. So we'll carry on holding those ones. And then the next sort of sizable portion of the portfolio, which again has also taken a large swipe over the last month and a half, is the clean energy sector. Again, if I just sort of illustrate the point slightly, if we switch to the TAN ETF, this is just particularly, this is just specified more to solar. This is solar stocks ETF, but you get the picture. We've seen a huge sort of run up until the beginning of this year, and then since then it's just absolutely plummeted. But it is a sector that I've been slowly giving myself more exposure to. To give you a bit of a backdrop on that, so clean energy stocks have been or had been flying up, and even more so when Joe Biden won the US presidency. It's quite well documented his stance on sustainability and clean energy. So I think there's a lot of anticipation around what the future could hold for these clean energy stocks now once sort of Joe Biden come into power. So there was a huge run up from that, and even when he sort of came in, there was a continued sort of surge in clean energy stocks. So like companies like Canadian Solar, Solar Edge, First Solar, a lot of the clean energy stocks, essentially there was a big run up in those, and then not long after, so where are we? We're probably around about sort of February time, he announced his huge infrastructure, the stimulus bill. I think it's like 1.8 trillion, the plans on what he was laying out for sustainability, green energy, EV technology. And rather than, I think initially there was quite a boost for for some of the clean energy stocks, and then from that point on, they've all just taken a bit of a nosedive. I mean, they were due to cool off because they'd run really hot. They were up huge amounts. So we basically phased into positions after that sell-off. We phased into some positions in some of the clean energy stocks that bounced around key support areas. Looking at it now, it could be that actually we didn't get in at what might have been perceived as a bottom. But again, similar scenario to the Chinese tech stocks, even though they've impacted our portfolio in a negative way. A lot of them have pulled back fairly heavily, especially sort of a couple of the hydrogen sort of exploration transportation companies, Nell, for example, and there is another one, but I can't see it, it's not to hand at the moment. Even though they've taken a bit of a beating, it's similar to the Chinese stocks. These are long-term investments. So just because they're pulling back at the moment, when you look at it long term, companies are all striving to be more sustainable. Clean energy is going to be a key economic driver for the future. There's going to be a huge amount of adoption for solar, geothermal, wind. So even though now it might be a bit of short-term pain, long-term, the idea is that these companies, we hold these for a while. Some of them we might trade in and out of as they trend upwards. But from a fundamental standpoint, I see great value and great potential. So we've just got to be patient with these ones. But again, similar to the Chinese tech, because they've taken a bit of a nosedive, they've pulled the portfolio in a downward trend. But hopefully you can start to see that even though there is drawdown on the portfolio, and we are, have had a couple of red months, the reasoning behind what we've got and why we're not closing out these positions is clear, and it's because the future potential is greater than sort of jumping out of them in a panic at the moment. And then sort of similarly, I guess the last sort of one that's not done too well, or the sector that's not done too well, is I've put US tech, but actually you could probably just class it as general technology, because I think they're not all US tech companies. These ones have been impacted quite heavily by fears around inflation. So just looking at some examples that I've got on here at the moment. So ones like Pinterest, Unity Software, Fiverr, Corsair Gaming. So a lot of these, you'd class these as growth companies, growth stocks. So at the moment, as mentioned, fears around inflation. The Fed said that they're not looking to raise interest rates to combat inflation until 2023. The markets feel like they might need to do that sooner, because especially if you look at some of the commodity prices at the minute, I mean, oil surging up, copper, lumber, prices are going higher a lot quicker than probably was anticipated. So the way that's impacting on the growth stocks is that if interest rates need to be raised, then the cost of borrowing for the growth companies, that some of them that may not be even turning a profit yet, will go up. So that will impact them financially. So there's fears around that. And obviously I think when you couple that with the last 18 months, a lot of the technology stocks in particular have done very well. So they will probably due a pullback. I think you're seeing quite a sharp sell-offs across the board. But, and there is a bit of a but here for me, again, I'm not overly concerned, even though it's a 10% exposure, roughly a 10% exposure. They're companies that are long-term. I'm happy to have in the portfolio. So, Pinterest, I mean, when that one dropped I've been watching Pinterest for a while, and I use Pinterest. I think it's a great app. I think it's got great potential. Similar, I don't want to peg this on and make bold predictions like this, but it almost reminds me of Instagram in the early years. I think it's got a lot of untapped potential. So as soon as that had a big sell-off, I think that's probably about 3 weeks ago, I jumped straight in on that. I may even add another position to that if I've got enough cash. I think that's got great future potential. Then there's a few others. We've got Roku, Elastic, Lamentum. There's a lot of sort of maybe more unknown companies that we really like. I like the look of. But then sort of linking from the US tech to also big data and AI. I mean, even some of these ones have taken a bit of a hit. Palantir, Splunk, and Alteryx have got 2.7% of the portfolio in Alteryx, and that is a data and AI analytics company that's done reasonably well. I think their recent financial results were really strong. The forward guidance looked good. And I just think big data and AI, and I'll throw cybersecurity in there as well, have got such a huge growth. It's got such huge growth potential. My background is in technology, so I use a lot of the tools or similar tools on a day-to-day basis, and I can see how it unlocks, or how it will unlock, the potential for companies to streamline operations, streamline processes, and I just think that to get in at some of these prices now, I mean Palantir as well, the amount of huge government contracts that's already got, I can only see that growing. So I think that for me, when I do, when you see the sell-offs that we're seeing at the moment in some of these areas, and they have had quite a big run up, some of them, you do maybe sort of doubt yourself slightly. But when I come back to my reasoning, which is, will big data, AI, and technology play a huge part in the next sort of 5 to 10 years? Is it a key growth area? The answer is yes. So not worried about holding these. Short-term pain, long-term gain. I suppose the only regret is that we can't add too much more at the moment, just because we've not got too much cash to hand. But that that may change if we trim out positions in other sectors. And then I'll just quickly try and cover off. There's a few more themes that I just wanted to cover off, really. So just because we have got quite a diversified portfolio, so I just want to try and give you an idea on, even though some areas aren't doing that well, which are the 3 key areas really, the key weighting, there are other areas that are doing well. So we've got sort of a 7% exposure to energy, to oil. So this is non-renewables. So companies like Royal Dutch Shell, Occidental Petroleum, Valero, and Suncor is quite a big holding for us. So this can probably tie quite nicely actually into the recovery stock sector. So this for me was a play that we've sort of been utilizing or been diving in and out of since COVID hit, essentially jumping in on good companies that were caught up in the sell-off because of COVID. So particularly aviation, I have traded in and out of a few aviation stocks to great success over the last 12 months. But I think oil, from a sort of a fundamental or macro view, the demand was obviously pretty much was non-existent last year when COVID hit and everyone was in lockdown. That was only going to ramp up eventually as lockdowns started to ease. So for me, that's a little bit of a no-brainer to have some exposure to that. No one can say exactly when that was going to take hold, but you can start to see it now. I mean, I think last year oil was well under sort of $30 a barrel, and now you're looking at $60. And I do think there's still some upside to that to go. I mean, may even be heading up to sort of 70, 80. So that for me was a bit of an obvious one to have some exposure to oil. And I've pretty much kept hold of those positions for quite a while. Similar to the sort of recovery stocks, we've got some exposure to IAG, which is that's International Airlines Group, which owns companies like British Airways, Aer Lingus, Iberia. That is quite a big operator. We've got some stock in that. I think that will do well, especially as you see today. I think UK Prime Minister Boris Johnson announced that travel will be allowed. So travel restrictions are easing, even though there's restrictions on certain countries you can travel to. Those restrictions are easing. I think that will then repeat across the world as the vaccine continues to roll out. So you're going to see a lot of pent-up demand for people wanting to go on holiday. I've been doing a lot of reading around some of the cruise lines. You know, I think some of the bookings that they're taking, they're booked up well until next year already, and they're still under, I mean, I don't think they're even sort of authorized to start sailing yet. So the demand is there. And I think having some exposure to those sectors will help the portfolio sort of protect against where you're getting the sell-off in tech and growth, and sort of give us a bit of exposure to these recovery stocks, particularly energy, aviation, and hospitality. But I do think that these are sort of more mid-term plays. So I do think maybe by the end of the year we would have phased out of a lot of these positions, depending on how the vaccine rollouts go, depending on what happens with COVID. But yeah, these are more sort of mid-term plays, whereas the the Chinese tech, the clean energy, the US tech, and big data, they're more sort of long-term plays. So that sort of covers off the recovery stocks play. We've got some exposure to healthcare, financial services probably ties in with my sort of an inflation hedge, I guess I'd put it. So I've got some junior miners as well. So I've got what have we got? Anglo Gold and Centamin. Sorry, I've got some head to read that on. Centamin PLC. So these are sort of mining companies that mine precious metals. So there's some exposure to that. I probably will add more. I've had Polymetal, which is the London listed precious metals company, and also Kirkland Lake Gold I've previously invested in. I probably will add more because I think the threat of inflation is starting to ramp up. And I still don't think, even though you've seen some of the commodity prices like copper, lumber, oil all go up, gold's not really done a lot. Silver had a bit of a burst, it's not done too much. So I do think those prices probably will go up as well. So having some exposure to those mining companies who will benefit from the higher commodity prices will probably do the portfolio well to protect against that inflation risk. And then sort of tying into that a little bit is the financial services investments. So there's a few that we've got sort of dotted around really. So we've got Credit Suisse, Itaú Unibanco, Branco Bradesco, some other sort of Stoneco. We've got sort of a bit of a mixed bag of financial services stocks. We probably will add a couple more banks. It's just the prices are so high at the moment. We did trade in and out of a couple of banks. I think we had Citibank at one point, which we made a sort of 40% profit on. But the idea with this is that, again, if inflation is going to be causing a problem and interest rates do need to rise, then the financial services, the banks look to benefit from that in a way that the interest rates rise, so the interest rates that they can then relay back to their customers, whether that's institutions, retail, they can then raise those rates and gain more back that way. So that gives us a little bit of exposure to that as well. And then I guess just lastly, just to give you an idea on what else makes up the mix of the portfolio. So you've got sort of a 7% exposure to healthcare. I think it's healthy to have a bit of exposure to healthcare. So I really like the look of Teladoc, which is a sort of remote doctor service. It's all done via the app. You can get consultations, diagnosis, all done via the app. So I think there's a couple of similar things in the UK. But I think the future for that is quite vast. So we've got a bit of a play on that, similar to Alibaba Health. And then there's a couple of other sort of healthcare companies that we've got investments in. Not really too much for me to say on those other than long-term plays. So happy to hold on to those. We've got a little bit of exposure, well, actually not really little, 7% exposure in a more sort of speculative sector. So again, these are more, I'd say healthcare, but more sort of pharmaceutical plays. So these are low cap, relatively unknown companies that I've done research on that I think could potentially do well, and they're in areas that, you know, there is a bit of an unknown, there is a risk, hence the title. I've put them as speculative. But companies like Zynerba Pharmaceuticals, for example, you know, I think this one a couple of months ago shot up by sort of 50% in one day. So Zynerba is a sort of cannabinoid biopharmaceutical company. Developing a cannabinoid gel for certain treatments, and it's still very early stages. It could be an absolute smash hit. It could flop, but that's the nature of it. So because it's small cap, you get a lot of volatility over a short space short space of time. So it can do absolutely nothing for a few weeks, and then one day, if it gets certain sort of FDA approval, which there's a timeline for that, and I've actually posted about this on my Etoro page in more detail. So if you wanted to find that, it'd be a good little read for you. But essentially, once they get certain or rejected or accepted certain FDA approvals, you can see stocks shoot up by, like I say, 50-60% in one day. So for me, it's a small amount of risk in relation to the rest of the portfolio for what could be quite a large amount of gains. And even though it's 7%, I mean, I think these are split across sort of maybe 5 or 6 different stocks. And if 2 or 3 of them do really well, then that would more than make up for the losses that we could incur on the other remaining 3. So for me, it's a little bit of a speculative play, but one that, you know, I'm happy to accommodate into the portfolio. And then there's just a couple more points to cover off. EV. So EV is a play that, you know, a lot of people want to get involved in. We've seen a huge run up in that. You know, everyone's been jumping on the background, even on the bandwagon. Even the sort of traditional automakers like GM, Ford. I think they saw the success of or the interest being drummed up in Tesla, NIO, and you know, they're realizing how important it's or what it means to people to want to be involved in that. So the EV sector is an area that's going to do well, but it has had quite a large run up. So you're seeing a sell off in it over the last couple of months. But we've got exposure to NIO, Geely, BYD, so the 3 Chinese companies essentially. And again, long-term plays those ones. And then just quickly to sort of round off overseas e-commerce. So we've got a small position in Alibaba and PDD, both Chinese sort of e-commerce companies. And then we've also got Jumia. Jumia is a stock it's essentially been labeled as like the Amazon of Africa. It's got unbelievable potential, but this potential might not be realized for sort of 10-15 years. So I had a position in it last year, sort of probably was around about sort of April, May time. And then it rode on the crest of the wave on the back of a lot of the growth stocks. And we closed out at about a 700% profit on that one trade. And since then, I've successfully traded in and out of a couple of trades. I don't think we've got a position at the moment. I think it's like 10% down. But long term, I'm really excited by this stock. But it's just one of those ones where it is volatile, and I probably will. It may be that I hold this one position and then add alternate positions and trade in and out of those, because it can drop at the drop of a hat essentially, because it is still a bit of an unknown. You know, it's doing okay. Memberships, sellers, activity on the site, it's all going up and it's heading in the right direction, but it is still quite an early stage growth company. But the potential to tap into the African market is huge from an e-commerce perspective. So yeah, it is an exciting one, but like I say, it could be one that might not realize its full potential for another 10-15 years. So we sort of got to be a little bit wary on that. And then just lastly, miscellaneous. So these are companies that I like, but don't necessarily fit into my wider themes. So companies like AMS AG, which is I think the Austrian it does sort of semiconductors, sensors, a lot of sort of optical parts and machinery for different industries, really, industrial, automakers, really strong financials. And I think it's quite heavily undervalued at the moment, actually. I think it had quite a bit of a sell-off a few weeks back on fears that its contract with Apple might be coming to an end, but it's rebounded quite strongly since then. I think it had its, or it did have its financial results, and forward guidance looked good on that as well. So again, a long-term play there. We've got Tough Built Industries. We've got Ship, which is well, essentially a shipping company. Again, sort of a little bit of a recovery play on that one. I think once economies open up and, you know, sort of e-commerce and shipping ramps up, then I think you're going to see a benefit for this company, for Ship. But hopefully this sort of gives you an idea on my thinking, how the portfolio is positioned, what the breakdown looks like, and why, even though, you know, we might still have another couple of months of red ahead of us. So what we were about at the moment, we're about 10% up, just under 10% up for the year. After today, that might drop to about sort of 8 to 7%. We may have another couple of red months, but I still think by the end of the year, we'll be there or thereabouts 20%, just because I still believe all of these sort of themes will pay dividends. Some even more so. I think once some of the Chinese stocks that we've got, the prices we've got them are just unbelievable. I think as soon as, you know, awareness and sort of favor comes back into these stocks, I think they're going to do extremely well. So happy to hold them, happy with how the portfolio is positioned. Like I said, we may trim out some of the recovery stocks and oil stocks as they continue to do well, and then redistribute those profits into other areas. But essentially that gives you an idea on why I'm not concerned, and the themes that I see going forward for the portfolio and for the market. And then just before I finish, there's probably one other thing that I wanted to sort of touch on, which is alongside all of the things that, you know, I've discussed, all of the different events, the macro picture. There's probably actually two more things actually that we to throw into the mix, really, that adds to all of the volatility. The talk around US tax increases, specifically the capital gains tax, I think increasing by a large amount, or being speculated to increase by a large amount, from I think it's early 20% to 41%, which is a huge jump. So that's targeted at the sort of the more wealthy individuals. So still unsure how that would impact the market. I don't think it will get to that level, but even so, it's another uncertainty. The markets do not like uncertainty, hence the volatility. So you throw that into the mix as well. And then you've also got the fact, which I don't think really many people are talking about, is the amount of new money that's come into the market in the last 12 and 18 months. And when I say new money, I'm talking about retail money. So, you know, a lot of people jumped in when the markets crashed in March last year, rightly so. The opportunity was there to get in on stocks at bargain prices. Then since then, people have obviously done well and talked to their friends, talked to other people, and more money's poured in. Then you've also got the stimulus checks from, you know, the US specifically, where people have been pumping that money into the stock market. You've got people doing well in crypto, which is causing, you know, more money to be distributed, not just in crypto, but back and forth into stocks and crypto. So there's a lot of new money, a lot of inexperienced traders, investors, which is why I think on days like today, you know, the NASDAQ down 2.55%. There's probably a lot of people that have never been in these scenarios before that are probably panicking, closing out positions. And there's definitely an element of the institutional investors, you know, the big hedge funds, playing on this volatility, pushing to see where they can, you know, catch out stop losses. You know, there's a lot of people that have probably done a lot of reading up and think that technical analysis is the be all and end all of being a good trader or a good investor. And, you know, you've got well experienced people in hedge funds and very, very smart people that probably understand this, understand where people are, you know, placing stop losses around support and resistance and just blowing through those just to get that volatility and sort of get those trades executed. So that's an area I don't think has been covered, which is, I think, is adding to the volatility alongside all the other macro events, is the new money, the inexperienced trader, the retail investors, you know, which I class myself as. I'm a retail investor. The only thing I would say is, because I've been doing it for quite a while, I know the importance of how, you know, the importance of psychology and discipline when it comes to trading and investing. You know, I'm not going to pretend that I'm the best investor there is or the most amazing investor, but what I can say is I've been burnt my fair share of times. And I think the one thing for me in all of the books that I've read, you know, you can be the smartest person in the world. You could be, you know, unbelievably clever, like a lot of the people at the big institutions are, but a lot of it comes down to psychology. If you are in a winning trade and, you know, you're completely convinced that this stock has another sort of 50% to run, or, you know, maybe not even looking at it as percentages, maybe you just know that there's more value to be had from it, but something happens in the news, or all of a sudden there's a big sell-off because of something that's out of your control. You know, you've got to be strong psychologically and very disciplined to say to yourself, well, hold on, you know, I know I've got conviction in this stock, so I'm happy to hold on to it no matter what. And like I say, you can be the cleverest person in the world, but when your stocks are nosediving and everything is going against you, probably like towards our portfolio for the last couple of months, you know, it's very difficult to hold tight and say to yourself, no, the vision is long term, I'm happy to stay in the positions I'm in. Flip side of that, of course, is if everything is going against you, you need to know when to sort of cut your losses, but I don't think we're at that point yet. But I just, back to my point around psychology, I think, you know, there's a lot built up around, you know, the technical analysis, the fundamental analysis. You have to know the ins and outs of a balance sheet, you know, what future growth looks like, P&E ratios, you know, Bollinger Bands, Donchian channels. You can look at and read all of these different, you know, pieces of analysis, and I have over the last sort of 7 or 8 years. But I'd say 9 times out of 10, it comes down to your psychology, your own discipline, and your own conviction in a trade. And yeah, that's, if I could sum it up as that, then I would. That's why I'm happy with our positions. And I think that's probably a good note to end it on, actually. So, as always, if you want to follow or copy my trades, you can do so on my Etoro portfolio, on my Etoro page, sorry, the pattern trader. There's a link in the description on this video. Also, if you wanted to stay up to date with my thoughts on the market and my closed and open trades on a regular basis, you can do so by subscribing to my YouTube channel.